So this video is about cash covered puts, and a cash covered put contains two separate positions: cash and a written put option. So the idea is that you could have two intentions with this. One, you could simply be trying to make an income and you have no intention of buying this, or you have an intention to buy, you're just trying to make it a little cheaper for yourself. Um, so what I will do in this video is to show a few scenarios how this would actually play out. So I'm going to go to TradingView, and I'll choose, for the sake of this lecture, a random stock like Exxon. Please note that everything in this video is for educational purposes only. I'm not giving you any financial advice. It's completely for paper money, and it's just random stocks and random prices, random strike prices. But everything is for educational purposes only. So this is the Exxon price on a daily for the past year, about past 12 months. And because of the coronavirus, the economies have suffered significantly, and therefore the oil prices has come down, and along with it took the oil companies with itself. So the price of Exxon went from $70 or $75 range average all the way down to a low of about $30. But because of the stimulus packages and the expectation of a market recovery, there's an expectation in the market that the price might bounce back. However, notice how right here the price have tried to come up but failed, and now we are on an average course of about $43. So what I will do is initially I will just show you the idea of the cash covered put. Now, on the video titled "How to Do the Cash Covered Put with a Thinkorswim," you saw that in the paper trade account that I have $210,000. So I have cash of $210,000 in the paper money account with Thinkorswim. So the problem is that because this is cash, it doesn't earn any interest. So my first intention is, so I want to call this, let's call this A, or scenario A, scene A, whatever you want to call it. And the idea is no intention to buy. And what I will do is I will write a put option on Exxon and earn income. That's very simple intention. So if you look at the TradingView, I'm looking at how, there could be several. I mean, you could do any sort of predictive analysis, but I'm just going to do a simple Fibonacci, and you can find more about Fibonacci under my website for Research and Teaching Associates LLC, or researchata.com. If you go and draw this from the top right before coronavirus to the bottom right at the crash of the coronavirus, notice how 39.82 seems to be a very good support point, and then 45.86 is a good resistance point. So I'm thinking about $40 would be a fairly good way to write my I don't want to buy, but I want the income intention. And but again, this is for paper money, and anything can happen. There's a second wave of coronavirus, and if things were to go down, and it becomes apparent that the economy will not be able to open back up, the price can actually dip below this. Anything can happen. So I need to have the cash to back this up. Now, this is not a spread. This is actually a naked put, but naked put protected by buy cash. Now notice, while I have no intention to buy, but I also have no objection to buying Exxon. Therefore, I'm willing to write a cash covered put. Now, I'll go over the strike price of 40. Let's just see what income I would actually earn from this. So I'll go to Yahoo Finance, and I'll go out about a month, so about 4 weeks for Exxon. And I'll look at the options, and I'll go for August the 21st. And if you look at the um, cash covered put at 40 for 1 month out, this is the bid column, and since we're writing it, we're going to look at the bid column, and that's 87 cents. So that's 87 cents. This is per share. So if we do one contract, this is your strike price, and this is how much you're going to be earning on this. Now, these are both in dollars. Now, notice this is actually your risk, and this is the income. And this is a monthly income. So let's look at, well, a little less than a month. That's about 2% and 18 to make on Exxon at $40. Now, obviously, what can happen is that Exxon can sag below the $40 level. And if that happens, I simply end up buying Exxon at $40. And therefore, in the account, I need to have $4,000 to cover that. And come the maturity of August 21st, I will have 100 shares at $4 a share, whatever the Exxon price is below that price. Meaning, if Exxon were to go down, say right here to $30 again, I'll still buy it at 40, because my commitment by writing that put option, the cash covered put option, is to buy it at $40. In a way, I'm creating I'm writing an insurance premium for insurance contract for those investors who own Exxon, and I'm basically telling them I will buy their Exxon shares at $40, whatever the price is. So obviously, if Exxon price goes up, then the insurance becomes worthless, and I'll get to keep my $87 or 2.18% income. But if Exxon were to go down, then I'll end up buying Exxon at $40, even though Exxon at that point could be lower. So there is risk. However, obviously, it is up to you to lower this risk. So, for instance, what we can do is, we can look at the strike prices that are possibly lower. So, if you were to look at a Exxon strike price that is below 40, obviously you will be lowering your risk of ending up with actual Exxon shares. So if you were to write it, say, at 38, then your risk would be somewhere around this level. And let's look at your price at 38 would be $48 or 48 cents per share, $48 per contract. If you wanted to lower this even more and say you want to go down to, say, 35, and at that point you're actually making about $20 for each contract. So it is up to you how much risk you want to take with respect to getting assigned and actually owning the Exxon shares. But since you have no intention to buy, it is, to lower the risk would mean lowering the strike price and therefore lowering your income. If you believe that Exxon is going to go up and you want to take some risk, then obviously you would increase the strike price and say that you think that it's going to go up from here and not down, and you want to actually come all the way up to say $43, and it's not, you believe that it's not going to go down anymore, it would just keep going up. So at that point, 43 gives you $195 off an income for each contract, but you're taking a significant risk, because if Exxon takes a dive and goes down to $30, then you will end up buying Exxon at $43 a share. Now, let's say that your intention B, or your scenario B, is we intend to buy Exxon. And now we will write a put option, a cash covered put option on Exxon again. But this time we are gonna buy Exxon cheaper. So what we will do now is we want to buy this. The current price of Exxon is $43.43, and I'm thinking that if we intend to buy this a $43.50 with a shorter period of time, say next Friday, we might be able to buy this. However, again, if Exxon goes up or down, our plans will change. But let's go with a $43.50, and I will call this income for the time being, but you'll see what I mean in a minute. The premium on this at $43.50, notice, by the way, that we're still writing the very same put. So $43.50 is $2.20. But this is for 1 month. So let's change this to a weekly. So this is just for next Friday. Let's go up to $43.50. That's 103. 103. Now, for one contract, that's how much it's going to cost us. And this is how much income we can generate. I'm still calling it an income, but you'll see what I mean in a minute. Now, so this is our risk, and this is our income, and this will become about this much of an income for the time being. Now, notice we intend to buy this, right? Because with this B scenario, our intention is to buy the stock. All we're trying to do is we're trying to make this a little cheaper for us with a cash covered put option, a written put option. We're basically saying you could simply go and say, I buy, in which case you're buying the Exxon at $43.43. You're buying it at the spot price. And today, or Monday morning, the first thing you do is you buy this, and then you're going to pay $4,350. That's it. You're going to buy it at or $4,343. And then you basically actually end up with the shares as of Monday morning, immediately. Instead, we say, okay, we think that Exxon may go up or may go down, and we're willing to buy this at $43.5. In fact, we intend to buy this at $43.50. Now, then we write a put option, and we write it at $43.50. We collect $1.03, and that's our income. And therefore, the net cost to us becomes $42.47. Meaning, on Friday's closing, if Exxon is $43.43 or $43.49, we end up buying it at $43.50. And that's our ideal situation because we intend to buy Exxon. Anything below 43.50, we buy, and we wanted to buy to begin with, and therefore, instead of buying it on Monday morning at 43.43, we actually ended up buying it, and it costing us 42.47. Now, the downside of this is that if Exxon were to go up, so come Friday, Exxon is $50. Well, then unfortunately, we couldn't buy it. And what happens is we collect the $103 of an income, but we wanted to buy Exxon, and therefore we are disappointed that we couldn't buy it. And the price is at $50 or $60. We missed an opportunity, and all we got is this lousy $103. Tough luck. So perhaps we could write the same option and with the same intention at a little bit higher strike, just to make sure that we end up actually buying this. Now notice we could write this put at, say, 45, right? So it's strike price of 45, and in this case, this is 197. Now, if you look at this, the net cost is 43.03, which means if Exxon goes up, great, but stays below 45, we end up buying it at 45. So this is versus buying it Monday morning at 43.43 versus buying it Friday at closing at 45. However, we collected the $1.97 premium for writing the option, and therefore we buy it with option, and therefore our net cost is 43.03, which means Monday morning, instead of buying it straight out at 43.43, we end up buying it at 43.03, 40 cents cheaper. Now, if we go, say, 46, it's 268, and then the net cost is 43.32, still 13 cents cheaper than buying it outright on Monday morning at 43.43. Now, the premium that we're collecting is going up. So if Exxon ends up being more than 46, well, you just collected $268. Even if it is 46.01, you're not going to buy Exxon at 46, but you will end up owning, or you will end up having $268 per contract. So writing a put, cash covered put, you could do it for two intentions. One, you have no intention to buy, you're trying to simply make an income, and therefore you want to keep the strike prices as low as you like based on your risk tolerance, and you're going to make an income according to the risk that you're taking. If you take a whole lot of risk and you write a strike price very close to the spot, then your income will be higher. But if you want to take very little risk and you want to write the strike price as low as you can, then your income will be significantly lower. Now, your second possible intention is that you want to buy Exxon, in which case you write a put option on Exxon. What you're doing is pretty much the same, except the strike price decision is affected by your intention. So if your intention is to buy Exxon, then you simply write a put option, and you try to buy the Exxon cheaper. And then you write your strike price at a level that you feel that will take place. Now, basically, the idea is to make this cheaper. So the closer you are to the current value, spot price, your net cost will be, or your premium will be lower, but your net cost will also be lower. But then if you start increasing your strike prices, then your net cost will go up, but still slightly lower than if you were to buy it outright. Now, there is a unintended benefit to writing a cash covered put if you are an institution and if you are buying a huge amount of stock without sending a signal to the market that you're buying this much of this stock. uh, Possibly one of the good ways of doing this is to write a cash covered put, because you will get assigned on a Friday night and Saturday morning, and therefore by the time people realize that you bought a whole chunk of a company, um, it will be, you will actually own it without having that impact of increasing the price. But that's probably not our concern right now. But for us to know, because sometimes from a high option open interest activity, and if there are spikes, then you can perhaps tell if somebody is actually trying to buy a significant number of um, shares of a company. It may have, and again, it may have some predictive value. But for our purposes, we either have no intention to buy or we have some intention to buy. And depending on that intention, we decide on our strike price. And if all goes according to plan, if we intend to buy it, we buy it, but we buy it at a cheaper price than we would otherwise buy it with a straight out buy. And if we intend to just make an income, all goes well, which means we don't buy it, but we get to keep our income. So this is the cash covered put. And please do let me know if you have any questions. And thank you so much.